Hello everyone. My name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. So at AIF and PMS Experts India, as you know, that we keep organizing these sessions, and idea is to share the details about what's happening in the markets, and also give you perspective on various offerings, both on the AIF side as well as PMS side. So maybe some of you might be aware that Marcellus has recently launched new PMS. So we thought of inviting two gentlemen from Marcellus. Both of them are seasoned investment managers, and we sort of reached out to them and invited them to come and speak to all our investors and share their perspective on new offering. So the agenda of the discussion is today to give you more details about the new PMS, which is Marcellus MeritorQ. That's available both under PMS platform as well as advisory platform. Today, the agenda is to talk about the PMS. And for that, I've invited two unique brains, I would say. So, Mr. Omkar Sawant, he's a chartered accountant. He's a fund manager for MeritorQ PMS. And prior to joining Marcellus, he worked with large CA firm in auditing department, basically from 2017 to 2020. He gained extensive experience across Indian accounting standard, financial statement analysis, as well as taxation. So he's kind of familiar with the entire audit aspect as well as the fund management part. So he's a BCom graduate from Mumbai University and he's qualified a chartered accountant. Then we have Mr. Krishnan VR. He's a CFA. He roughly has close to more than a decade of rich experience in terms of investing, both on the equity as well as fixed income side. And before joining Motilal Oswal, he was involved with new index development team at Morningstar, where he used to create quantitative rule-based equity investing across the multi-asset, asset classes, more on the investment product side. So prior to Morningstar, he was an equity analyst with D. Shaw and Company, which is very famous for its own first-hand research. So clearly, both of them bring a good amount of experience. Mr. Krishnan more particularly involved in terms of creating a more of quant-based funds, and quant-based funds requires a lot of data analysis, more on the back-end side, and then come to a conclusion of creating something the way you want to create. So today we thought we'll read their mind, understand that how did they come out with this PMS, A, and B, what made them to think in these lines. So these are few questions that we have. So overall, we have close to 30 minutes for the presentation, including the presentation they're going to run. And then we'll open the forum for question and answer. So firstly, Omkar and Krishnan, many thanks for accepting our request and taking the time out from your busy schedule, gentlemen, and joining this call.
Our pleasure. Yeah.
So my first question is, Omkar, you are the fund manager. So if you can take us through the process of how you want to manage funds, say, our investors who have already invested money in CCP, Rising Giant, let's say they give you additional mandate of 50 lakhs rupees. How are you going to deploy and how are you going to look at various aspects? So over to you.
Yeah. So basically, in the MeritorQ PMS, the strategy that we are following is more from a quantitative side of things rather than the qualitative side of things, right? But what the investor needs to understand is that as a firm, as Marcellus, our core principles haven't yet changed. So there are basically the three layers that we look at, right? Which is competitive advantages, clean accounts, and uh, basically consistent profitability, right? So of all
Yes.
of these, yeah, so all of these three aspects, so all of these fundamental aspects, they have still uh, they have remained with this quantitative process. So
Right.
usually what we see in a quantitative process, right, it's that it is just looking at the prior numbers that we tend to overlook at all of these softer aspects and maybe go into higher turnover portfolios. But this is not what we have tried to do with MeritorQ PMS. So for a typical investor, it is just like another product of Marcellus, but the approach is entirely different, while the outcome is similar to that of other portfolios.
Sure. So can you just talk to our investors and talk about how are you going to look at valuations? Any rule that you've decided to set for this particular PMS, or do you have any presentation that you'd like to share?
Yeah. I guess we can jump on the presentation right away.
Sure.
Yeah, so Vikas, just to give also a background on Krishnan. So Krishnan is sort of the main architect of the entire portfolio construction process
Sure.
behind the MeritorQ PMS. I bring more of the fundamental firepower which is needed in terms of forensics and everything. Krishnan will explain that in more detail.
Sure.
But I'll hand it over to Krishnan to take over these slides.
Yeah.
Okay. I hope the slide is visible to everyone.
Yeah, slide is visible. Can you turn the video a little bit towards Krishnan? So, yeah.
Yeah.
Is that better?
Yeah, better. Yeah, please go ahead.
Okay. So I just thought maybe given what we have discussed till now, it would be at least walking through the key investment objectives of the strategy which we are going to talk about today would be a good place to start from. So again, we will just touch upon this key investment objectives in this slide. Now some might also call this timeless wealth creation principles, and this would be number one, to buy good companies, which I'm assuming most of you who are present here would know that Marcellus, that's been our philosophy, our investing philosophy essentially. And again, when you say good companies, good or quality companies can be defined in numerous ways. But in this strategy, we consider a good or a quality company as those with high returns on capital, either a high return on capital employed or a similar measure, or a return on equity for, say, financials. And then a solid financial condition. When we say solid financial condition, again, we are looking for companies with low financial leverage measured by debt to equity, and clean accounts. Again, when we say clean accounts, companies which qualify or pass per our the forensic accounting screen. I'm sure many of you would also be aware, when we say forensic accounting screen, or the ratios which we use to basically screen companies, which we believe are either are misrepresenting their accounts, or their accounting is not completely clear, or they have some other governance issues. So that being our definition of good companies, right? But again, when we buy these good companies, ideally we want to buy them at prices below the intrinsic value, right? And when we say intrinsic value, again, there can be various definitions of intrinsic value. But in this strategy, we consider intrinsic value, or define intrinsic value on a relative basis based on free cash flow yield, right? And again, why free cash flow yield? Again, this is again in line with the way we have approached valuation or looked at valuation, because again, a lot of folks again in the market, or traditionally they have looked at price to earnings, price to book, or some other these ratios. But what we have found is free cash flow, or companies will generate free cash flow generally deliver better superior returns, and free cash flow as a metric again is a better predictor of future returns than any of the other traditional ratios. So again, that's the reason we have gone with free cash flow yield as the a measure of valuation. Now when we buy undervalued and good quality companies, we want to control our emotions and human biases as much as possible. And the rules-based approach which we are taking, or the quantitative approach we are taking in MeritorQ, kind of helps us in that direction, because discretion is minimized, and we'll come to the actual portfolio construction steps in the subsequent slides. So the discretion is completely minimized, and you follow a disciplined investment process where you rebalance this entire portfolio basis a set of rules once every 6 months, right? So it completely follows a set process, and the process is again repeated, per a set frequency. So we rebalance this whole portfolio on the first trading date of April and October every year. So again, buying good undervalued companies and again controlling human biases or mitigating human biases as much as possible. These three being the key investment objectives of this of MeritorQ. Moving on, so as as we talked about the the investment objectives in the previous slide, let me also take a moment and also mention that while we take a quantitative approach, we have consciously sought to avoid what's known as LSD, right, in investing, which is leverage shorting or derivatives. Again, there is no hedging involved in this portfolio. It's a completely long only portfolio. We don't take any explicit cash calls also. Again, this is completely based on our good investing principles or the investment objectives which we talked about in the previous slide, and our proprietary investing framework, our investing, the Marcellus philosophy towards investing as such. Okay, we'll take a brief detour and try to explain how this approach of buying good quality but undervalued companies is similar to the so-called Moneyball approach. I don't know how many of you have heard about this particular book. So this approach was popularized by this in this book by Michael Lewis, which was published in 2003. A popular movie on this book was also released in 2011. The story is about the 2002 season of a baseball club in US called Oakland Athletics and its general manager Billy Beane. Again, this particular club, Oakland Athletics, wasn't the club with the largest fan base or recall value, and the general manager Billy Beane had just started out in his career just a few years earlier. However, Oakland Athletics achieved something quite unprecedented in 2002. This is kind of the subject of the movie as well as the book. So they went on to have a 20-match winning streak, and that was kind of a record so they went on a 20-match winning streak, which was a record of sorts for the most number of wins on trot for any team till that time. And they eventually went on to win the Western Division of the World Series baseball that year. More impressively, they did it at almost half the budget of some of the larger clubs, like, for example, New York Yankees or Boston Red Sox. Because he was the club and as well as the general manager Billy Beane, he was on a tight budget because it was a much smaller club. He was basically looking out for players who could help him win matches cheaply. Before this, baseball players were selected from college campuses by scouts based on their ability to run, throw field or hit with power and other physical attributes, visible physical attributes like height, build, etc. This process relied on the gut and intuition of the scouts, and which in turn was based on their experience. Now, what Billy Beane did is he completely did away with this conventional wisdom by completely doing away with scouts and instead applying rigorous quantitative analysis to historical data to identify key player attributes that contributed the most to their wins. In a similar way, in the MeritorQ, we have used a rules-based portfolio construction process to create a portfolio of undervalued but good quality companies. Like cricket, baseball is a team sport, so Beane was focused on creating a team with complementary skill sets. Similarly, our focus in this strategy is to combine two uncorrelated factors like value and quality to deliver a superior risk-adjusted outcome. Instead of, for example, just focusing on, say, a particular player in a Moneyball context or a superstar stock in MeritorQ's or a portfolio context. Also, if Billy Beane or Oakland Athletics, they found a better value for the price they were paying for a particular player, they were not afraid to swap such established players with rival teams. Similarly, our strategy refreshes the portfolio, like I said, once in every 6 months, based on, and we will see the actual portfolio construction steps in the subsequent slide. Okay, so this was just just an example to just explain, right, what we are doing and how it's similar to the so-called Moneyball approach in baseball. Now, coming to the actual portfolio construction steps. So in this strategy, we start with a wide selection universe. So consisting of stocks across the large, mid, and small cap spectrum. And this would be equivalent to a BSE 500 or an NSE 500 universe. We then weed out companies, which we deem not having clean accounts according to our forensic accounting screen. Also remove those with high financial leverage measured by debt to equity. And the primary function of these two screening steps is to reduce risk. Additionally, we also screen basis consistent profitability, and the purpose of this step is to again remove highly cyclical companies where it's difficult to explain how the earnings, or the fundamentals might trend over a 1-year holding period. After screening, we select stocks which rank high on both profitability and value. Again, to emphasize, we are looking for stocks, which are scoring well on both profitability and value, right? So it's not either, but both. Again, the question here would be, why are we taking this kind of a selection approach? So, the simple reason is value stocks, typically outperform when the economy is coming out of a recession or a downturn. While quality, or the good stocks or the good companies we talked about, because these tend to be more resilient businesses, more profitable businesses, they tend to do well during recessions. So the benefit of combining two uncorrelated approaches, selecting on quality and value, is that it helps in delivering better risk-adjusted returns across the full economic cycle. So during a recession, as well as coming out of a recession, quality and value are firing at different points in time. A strategy, again, just based on selecting undervalued stocks could lead to value traps. Similarly, if you're just picking high quality companies without any regard to, the buy price, again, that also does not make sense. So this is, also similar to, again, the Moneyball approach, which we talked about in the previous slide, which we have used in some ways in constructing MeritorQ. And then, once the portfolio, the final portfolio is created basis, the selection step, the selection criteria we talked about, we position size the final portfolio such that the more undervalued stocks, get higher allocation. And this position sizing is basis free cash flow yield again. So when we say value everywhere in this slide, again, we are referring to free cash flow yield. So free cash flow yield is used both in selection jointly with profitability, as well as it's used in the final position sizing, the portfolio position sizing. And of course, this whole set of steps, starting from the initial universe to the screening, selection, and the position sizing steps are repeated once every 6 months. Again, on a fixed basis, again, on the first trading date of April and October. Moving on, so we simulated this approach over a 16-year period between July 2006 and August 2022. Again, please note that this is based on a back-tested data, and when we say a backtest, we have used the data as of that point in time. But this is not the live performance, right? So the live performance, is relatively short because the portfolio went live, just some weeks back. But again, whatever we'll be discussing here is based on the 16-year of back test, right? Just to be clear. Now, just if you look at the stats on the right side, what we see is, roughly over this period, this particular approach, which we talked about on slide 5, roughly gives us somewhere between a portfolio between 35 to 45 stocks. Over the 16 period, no single stock has ever, got an allocation of more than 12%. The weightage to the top 5 stocks has varied between 20 to 30%. Whereas the small mid caps, rough allocation has varied between 40 to 62%. Again, when we say small mid caps here, we are referring to the bottom 300 within the BSE 500 or the Nifty 500, stock universe. The average annualized one-way turnover for this strategy is around 50%, right? So roughly half of the portfolio is churned out every year. Again, when I say average, again, this is over the 16 years of backtest which we have done. And then on the left, the chart shows the average sector allocations, which we have seen again over the 16-year backtest history. Again, the maximum allocation you would see is to some of the consumer sectors, consumer staples, discretionary, as well as IT. Again, no surprises there, because over the history, or I'm sure many of you are aware, these sectors tend to be the one with some of the best free cash flow generators, right? And you'd also notice that we don't have some of the more cyclical sectors like real estate or energy, and that's simply outcome of our consistent profitability screen, which we discussed in the previous slide, where we kind of screen out most of the ultra cyclicals from the portfolio. And also please note that there is no constraints on allocation to either a single stock or a sector as part of the portfolio construction rule. And this is in a way intentional, as we want to be guided by fundamentals and select the best companies which meet this criteria of being both profitable and undervalued, and position size these accordingly. Right. So, and there is no reason to believe that, a particular, the kind of stocks we are looking for would be found in only a particular sector or a set of sectors. So again, there's no constraint on a sector allocation or allocation towards a single stock. Moving on. So we also, here we can see the portfolio characteristics. Again, this is over the full backtest period, and you can see the outcome of our portfolio construction approach, or the rules which we talked about on slide 5, and how they reflect in terms of the final portfolio characteristics. So, for example, the debt to equity of this portfolio is 110 that of the BSE 500 equal weighted portfolio. Similarly, profitability metrics, whether you look at return on capital employed or return on equity, is almost twice that of the BSE 500 equal weighted portfolio. And when you compare on basis of valuation, again, we have just shown the red chart, or the red line chart on the right side, is that represents the free cash flow yield of MeritorQ, and you can see that's consistently above the dotted blue line for the BSE 500 equal weighted portfolio. So again, the purpose of what we are trying to show here is the portfolio construction steps which we talked about on slide 5 is giving us the desired portfolio of undervalued yet good quality companies. So I'll just hand this over now to Omkar to walk you through the rest of the slides.
Thank you, Krishnan. I'll take everyone through the backtested performance. So basically, the top chart that you see on this slide is right. The initial, if you had started with an initial corpus of around rupees 10,000, say invested in the strategy in say around July 2006. So the top chart shows how the strategy roughly would have returned. So this roughly translates to a 20% annualized returns over a 16-year period. So, however, one should also note that this is backtested performance, which is gross of transaction cost or tax or any kind of brokerage or expenses. So, and this performance also shows the price returns and not say the total returns for the portfolio. Then moving on to, say again, these are annualized returns, right? But for us as investors, what is essential is how the rolling returns of the portfolio looks like. So basically the bottom, So basically the bottom left chart, it shows that as we increase the holding period, the variability of the returns, it reduces. So you can see, right, that the red line in this chart, it shows the variation in terms of 2 standard deviations. So you can see how the red line, it almost goes flat as we increase the holding period from say 12 months to more than 36 months. So you can notice at the 12-month mark, your portfolio can deviate, say, positive 80%, negative 40%. But if you go to more than 36 months, it can say range between positive 40 to even say negative 15%. So, which is what we are recommending, say, not just for this portfolio, but for any of our Marcellus portfolio, that the holding period should at least be more than 3 years rather than a shorter holding period. Then again, the bottom right chart also also illustrate again the same point. So the bottom right chart, what it shows is that the red bars here are basically the 3-year rolls of the portfolio, and the blue bars are actually the 5-year rolls of the portfolio. So you can notice, right, how the red bars are more dispersed than, say, the blue bars, right? And what's more interesting is that during the 16-year backtested period, there are only 7 instances among the 200 3-year-olds where the returns were negative, and no instance in the 5-year-olds where the returns were negative. So you can again understand the point of holding at least more than 3 years, right? That there is no capital loss if you hold, say, for more than 5 years. Also, needless to say, this portfolio also outperforms the Nifty 500 in every 3-year and 5-year monthly rolls as well. That is what we have witnessed in the backtest. Then moving on, yeah. So in this slide, what we have tried to show is how our strategy of selecting undervalued but quality stocks compared had you just selected quality stocks or just selected value-based strategies. So basically, what we have tried to do is proxy these pure strategies with the Nifty quality and the value indexes. So this basically reiterates the same point that Krishnan had tried to make earlier, that our focus in this strategy is to create a portfolio based on this uncorrelated factors of value and quality, so that we as investors we get superior risk adjusted outcomes. Yeah, then moving on further, there was another point that Krishnan made, right? Very briefly spoke about how the strategy delivers better risk-adjusted returns in different stages of the market cycle, right? So in this slide, we have dwelled deeper into that aspect, where we have taken two examples of how the strategy actually performed during the two big events that we had witnessed during the backtest, which is GFC and the Corona crisis. So you can see at the bottom of both of these charts that the drawdown of the portfolio is almost 5 to 7 percentage points lower than that of the benchmark. Whereas since the value band that Krishnan mentioned, it performs really well when the economy is coming out of a recession, right? The value band helps the strategy recover faster than the benchmark, and thus we as investors we get better risk adjusted outcomes. Yeah, then moving on. So basically in this slide, what we have tried to show is how the calendar year returns of the portfolio looks like. So in the 16-year backtest, what we have witnessed is that this strategy underperforms the benchmark has underperformed the benchmark only in 2007, 2019, and the year-to-date performance. So basically the period where you cannot make sense of what stocks in the benchmark might run, say something like which is poor quality or even poor on growth. Maybe that might take the benchmark higher. But again, like Krishnan mentioned, these stocks will be removed at the screening step itself, where either they would be filtered out on forensics because of, say, bad corporate governance practices or accounting jugglery or something, or maybe these won't be consistent profitable sectors, right? Or maybe consistently profitable stocks. So if the benchmark runs basis what this strategy won't ever go into, then those would be the years when this strategy would underperform. But what I just mentioned in the previous slide as well, right? That the investment horizon, if you keep 2-3 years or more, then the chances of us getting an inferior outcome to the benchmark is quite low. Yeah, so basically, I'll just try to summarize this strategy. So, this strategy is a multi-cap and a multi-factor one with diversified exposure to both value and quality factor. And it also invests in stocks across the capitalization, market capitalization spectrum. And as we mentioned before, right, we try to pick the best stocks from the large, mid, and small cap spectrum by comparing the quality and the value characteristics of the stocks with all the stocks in the universe, right? So this approach, it harnesses the operational efficiency of the quantitative investment process. Uh, Secondly, the periodic, sorry, I just yeah, sorry. Secondly, the periodic rebalancing which Krishnan mentioned, right? So the periodic rebalance, semi-annual rebalancing is done twice a year, which is effective on the first trading date of April and October. So what this ensures is that the portfolio is aligned with the investment objectives which we had discussed, and it also strikes a right balance between first incurring too much churn and say picking up all of these undervalued stocks regularly. So we also tried all of these quarterly, monthly, say other rebalancing frequencies. But what we found was semi-annual rebalancing strikes the right balance between not incurring much churn and picking up such stocks regularly. And say also lastly, this is a rules-based product where the construction process has been validated across a 16-year MAC tested history. So by rules, what we mean is that there is minimal discretion in the investment process. And here I would like to focus on the word minimal, where there is one layer in the final step where we remove stocks basis corporate governance issue. If as a firm, Marcellus would never invest in these stocks, then we would remove them. Otherwise, the entire portfolio is rules based. But what we have seen over the backtest is it's usually all of these corner cases which get removed and say not majority of the portfolio. Then again, there is also no star portfolio manager risk here. So the portfolio manager only, uh, uh, so the portfolio manager, he doesn't drive the say stock selection or say even the position sizing. The rules and the final portfolio are subjected to oversight, but what goes into the portfolio is not upon the portfolio manager. So, what we also expect is that these rules can say evolve further, but be rest assured that any revisions to the existing rules will be objectively and say thoroughly validated. Say while adhering to all of the investment objectives that we stated. Yeah, over to you, Vikas.
Okay, so thank you for the presentation. Uh, we got to understand today that how it functions and how it rebalances every 6 months. So half yearly is what you are talking about, that automatically it will rebalance the portfolio. Obviously the fund manager would evaluate and then decide. uh, is that correct?
Yeah, so the portfolio as such is driven by the algo, but only the final portfolio will be subjected to oversight by the portfolio manager. Say something like a stock with a corporate governance issue, if it filters in, then that will be thrown out and say distributed between the rest of the stocks.
Right. So in a way, I would say that it is a human plus machine both. It is not pure
Yeah,
machine, right? As in,
yeah,
when you
yeah,
are selecting stocks also, then you would also be looking at your own universe, and from there only you would be picking up. I mean, any stock which is not does not qualify in terms of coming into your universe, as in if the forensic check is not approved, etc., and not clear, then those stocks will never be bought under the portfolio. Is that correct?
yeah, yeah. Those will never be bought.
Yeah. Okay, I got that. So we can open the forum for question and answer. So all those who have joined, thank you so much for joining in today. And if you have any questions about anything, please feel free to type in your questions in Q&A box, or maybe in the chat box, which may be on your right hand side in your screen. The first question comes from Mr. Prabir. He's saying that 16 years of back testing means you will not consider any companies having less than 16 years of financial history. Is that yeah? Question is that please, Krishnan.
So, I don't think that's correct at all. So because when we say 16-year of backtest, we have created 6-month portfolios, right? So every 6 months we have rebalanced per the rules which we discussed on slide 5. Every year in those 16 years. It doesn't mean that today we are creating a portfolio based on 16 years of history. I hope that's clear, right? Because and at the most, for the portfolio construction, in any particular year, we just use last 3 to 5 years of data.
You can turn off this presentation so that we can discuss in detail.
Yeah.
So my question, Krishnan, here is that, so why did you take 16 years of time frame? Generally, you look at a decade or two, 25 years. So what was the reason to be more specific that you looked at only 16 years of backtesting?
So the simple answer to that is because we were restricted a bit by the data, right? The quality of data. So when you go back, especially before 2005, there are a lot of things, which are, first of all, not available, or even if it is available, it's not reliable, right? This includes the fundamental data, etc. But that's why we have also shown rolling returns, even what we discussed, right? We showed 3-year rolling returns, 5-year rolling return, just to rule out the fact that someone might ask us if you have chosen the the starting date for doing the backtest return or even showing the performance, which is not the case. We are simply restricted by the lack of data. That's why we kept it to 2006 as far as back.
Yeah, honestly, if it was upon us to select the starting date, then what you said, maybe a decade would have been better to show returns.
So you looked at the best possible data. Sure. Based on that, you started analyzing it. And then you derived to this sort of calendar year returns, financial year returns, and rolling year returns, and also looked at the entire CAGR process. So I got that.
Yes. But what the investor needs to look at is the rolling returns, because that will be the average investor experience.
So when you looked at the data and did your own backtesting, so how is the rebalancing done there? Like, because when you are putting rules and defining the quant, how did you look at rebalancing in those years?
Yeah, so look, the need for rebalancing comes because you want to refresh the portfolio, right? Now, if you create a portfolio and then you hold it for a year, right? It could happen that some of the stocks, you would have selected those stocks based on a particular investment thesis or the data available, say 1 year back, right? Now, today the data would have changed. Now, some of the companies could have either improved or some of the companies would have deteriorated on the fundamentals, right? Now, when you do rebalancing, right, it allows you to reflect the the updated information, right? And when I say updated information on how well the company is allocating capital, for example, which is measured by the return ratios, return on equity, return on capital employed, or profitability, what we discussed, right? Similarly, if a company is not making it through our forensic filters, right, that would also become apparent, right? Year on year, if, for example, a company was making it or passing through a forensic screen before, now if we suddenly see that the company is doing something, either in terms of the governance has become lax or the accounting is not up to the mark, that will immediately reflect in the forensic ratios and it will immediately be screened out, right? So that's also a purpose of the rebalancing, right? Now, the other purpose of the rebalancing is, especially in what we are doing in MeritorQ, is to reflect a valuation aspect, right? The valuation aspect is, where we are trying to pick up, what we are calling as undervalued stocks, right? And when we say undervalued versus the free cash flow generation ability, that's why we are defining it basis on free cash flow yield, right? Now, when you pick up undervalued stocks, ideally you want to pick them up at the point of undervaluation. You want to hold them for enough period for them to cover or come back from that undervaluation to reach their fair value, right? Now, typically in this portfolio, what we do is we buy undervalued stocks, at least hold them for a year, and then we again see whether the stock is still undervalued versus all the stocks in the universe, right? So, if for example, in the next rebalancing, we find that undervalued stock, what was undervalued say a year back, now it's no longer undervalued. So the purpose of rebalancing in that context is it will be thrown out again, right? And another undervalued stock or a profitable undervalued stock will again make it into the portfolio, right? So in a way, if you think about it, both for the valuation and for the screening steps which we have, rebalancing is kind of essential, right, for this this whole strategy to work. And that's the reason we have this rebalancing. And also, someone might ask us, and I'm sure that could be one of the questions from the audience, on why semi-annual, right? Why not say quarterly? Why not do it monthly, right? Now, we tried again all these different approaches, but what also happens is if you increase your rebalancing frequency, right? If you churn, you do all the steps, more frequently, the churn goes up, the turnover goes up, which is again a cost for the investor, right? But if like I told you, if it rebalance less often, you are reflecting the updated information much less regularly, right? So there is a trade-off we need to balance. One is to rebalance a lot and incur lot of turnover versus rebalance very maybe just once in a year or once in 2 years. In that case, you are very slow to change your portfolio, either basis valuation or fundamentals. So what we found is the semi-annual rebalancing gives us the ideal trade-off, right? Where you have a churn which is reasonable, a 50% annualized churn, which is fairly reasonable, and you also get the benefit of the fundamentals as well as valuation reflecting in the final performance, the final strategy performance.
Sure. A couple of questions. So another question coming from Mr. Rakesh Pandey. What if there is any corporate governance which comes before scheduling the rebalancing, which is semi-annually? Like, for example, is the third month going on and some sort of corporate governance issue comes up. So would you be changing the stock, or how would you deal with that?
No, so we won't take any action in that case, Vikas, because these are the rules. They are stated rules. We don't intervene at all in between to rebalance. And the rebalancing is done at those dates for all the clients without exception, right? And
knowing the fact that there is some problem and probably the fund manager might have to take a call, then probably you will be discussing amongst your investment team members and then take the final call.
Yes, we will definitely be discussing it, but we won't take a call at that point in time, right? The simple reason is, look, a lot of these things, what we have also found out is sometimes the market overreacts, right, to negative news. Some of it is speculative news also, right? So it even takes a bit of time to even understand whether, there's a real problem with the company or, the news itself, whether it's a rumor or the news, right? So again, because this is a rules-based portfolio, our bar for excluding such stocks is exceptionally high. Remember, right? But in all these cases, right, if we find there is a good basis, if there's a change in our view of particular company which we had considered to be fairly good on corporate governance metrics, but some new information comes out between two rebalance date, that will be noted, but that will be then considered in the next upcoming rebalance, right? So at the most, an investor would be exposed to, say, a 3-month period where, or say a 5-month period max or a 6-month period max, where a negative news would have come and, it's kind of delayed, or that stock, we are delayed in removing that stock from the final portfolio. But given the forensic accounting screen and, all the other steps we already have, we expect, again, that's what we have seen. And that's what we told you also before. We expect such instances to be, very, very uncommon.
Yeah, there are just
knowing the fact that in the past I mean, you see some balance sheet starts getting manipulated and you don't get to know about it. So anyways, yeah, that's a question. Next question is, so we have only 15 minutes left out. Sorry, Omkar, you were saying something, then we'll take more questions.
Yeah, sorry, I just wanted to add 2 points to that quickly. So it's just that since this is a rules-based portfolio, right? The more discretion we bring in the portfolio selection, it's just that we might never be able to, anyone might not be able to draw the line as to where one might stop, right? And the second point is that in the back test, what we have tried to do is we haven't accounted for corporate governance, right? Because that would be a hindsight bias, right? So even after not accounting for corporate governance, still the portfolio returns remain intact. Uh, so that I guess it speaks for itself.
So even without the corporate governance screen, the point Omkar is making is you get a 20% annualized, return which you see in the back test.
Right.
Sorry, Vikas.
Next question is from Mr. Vasudev. He's saying that knowing the fact that these products are available under both the platforms, which is advisory as well as PMS. So why would somebody look at PMS? Why not to start with advisory? Would you like to answer this, or I should answer this?
Whatever. So
I'll answer this question. So
Okay.
because we manage these things. So see, Mr. Vasudev, you have both the options available. If you think that you can do the rebalancing at your level, you can start with 10 lakhs rupees, come under the advisory, sign up, and go ahead. But there are investors who are fully occupied with their occupations and they don't get time to rebalance, etc. So they would like to give the mandate to Marcellus and let the fund manager to decide and do the all sort of rebalancing, etc. So it's purely your call based on your own, depending upon your schedule. If you think that you can manage it, then you can start with advisory and then build on it, increase the amount. If you think that you don't have time, then you can give the mandate to Marcellus. The portfolio would be, I think, more or less same only. Of course, there will be few changes depending upon time to time, depending upon how the market situation is. And Mr. Vasudev will be taking the call accordingly. Next question is,
That's what we'd say.
yeah, anything you want to add?
No, it's just that the execution capabilities, those stay with us. So it's like you mentioned, right? There are all sets of plans.
Sure. So next question is, quickly, please tell us about forensic of a company, how to screen out bad ones. Like, so you will follow the same philosophy, what at a broad level, Marcellus investment philosophy, right? Like in terms of
Yeah. So these are the same kind of forensic ratios that we have used so far, which it's all relative basically. So there are companies which score consistently better on all of these metrics. Those will be placed in the higher ranks, whereas some will be placed in the lower ranks. And what we have found is that in the lower ranks, there are 2 points. One, there are usually some accounting jugglery or corporate governance issue, and usually these sort of companies there are horrible in terms of risk adjusted returns, right? So we don't tend to invest in these bottom deciles, which is what the forensic does. So it's the same thing that Marcellus has used so far.
The next question is, how would you charge in case of PMS? So I'd like to answer that. See, in case of PMS, the charges will be deducted from your account. Whereas as per the SEBI guideline, if you're opting for advisory, then you'll have to pay the fee separately. That's how it is done. Probably we can take the question offline more in detail. You can reach out to our team, expert team. Next question is, the next question is, so would we have to actively buy the stocks you recommend, or we would be passive investor? I think this is more to do with advisory.
Yeah, so this would be if you're going through the advisory route, the stocks will be bought, through WellDesk. So WellDesk is a platform, where they allow you to buy portfolio of stocks. So you can buy this portfolio, subscribe to this portfolio on WellDesk, and what will happen is when you place the final order, the stocks will be bought through your brokerage account.
Yeah. So your Demat account gets linked with your.
Yes. So the execution, etc., happens through the
Well,
broker, through your broker, the
so,
client's broker.
okay, so for that we'll probably have another session where we'll give you more details about how technically it functions, etc. So today we are here to talk to you about PMS. So next question is how is the allocation between large cap, mid cap, and small cap historically?
Yeah, so large cap is the slide which we showed, we discussed. So we roughly see allocation of between 40 to 60% in small and mid caps. And when we say small and mid cap, this is the bottom 300 in the Nifty 500, right? So that could be slightly different from the SEBI defined SEBI definition of a small mid cap, which would be the bottom 400. So if you go with the SEBI definition, this number could be higher. But roughly we see 40 to 60% allocation towards small and mid caps.
Okay, okay. And the next question is, so what is the duplication in terms of stocks? Like you have when you're running other strategy like CCP, Rising Giant, and Little Champ, and somebody is having, let's say I'm your client and I have all three portfolios, then what would be the duplication ratio?
So basically, the overlap with CCP is just one stock. With LCP, it's two stocks, and with RG, it's again another two stocks. So basically, the overlap is very low, and basically the process I said, right, the process is different, outcome is the same.
Yeah. And plus, I just want to mention this to our investor that this will be rebalanced also every 6 months. So you never know. Like if you look at, you go for CCP, these are portfolio that you're building it for long term. Like it's your core portfolio. As Saurabh says that this is like your dal chawal. Core portfolio. You have to have exposure in these good 13, 14 monopolistic businesses of India. But when you are building up these sort of products, and when you're building up the AUM in these kind of products, obviously you need not to think about portfolio because you are actually giving the mandate to the fund managers of Marcellus, and they have done sort of analysis and then putting up rules based, framework. So obviously the outcome would be different, and you should not be looking at stocks, I would say. Okay. The next question is. It comes from Mr. Uh, Devanshu. Okay, that is done. Okay, all right. Okay, so next question is from Mr. Satish. He's saying that most of the mid caps and small cap mutual funds, they're giving about close to 20-22% of CAGR returns. So, what is the advantage of investing through MeritorQ?
Look, I mean, the simple, answer to that is, look, if you believe in, the Marcellus way of doing things, right? Our core investment philosophy, right, where we again are looking at good, clean accounts, companies which are generating consistent profitability, companies, again, very good companies, right? And in this case, we are also looking at undervalued, good quality companies. If you believe in that, and again, the outcome is the function of the process, right? I think our process is unique. It's and I'm sure people, if you've heard again from us through different means, we would have realized that we don't follow the crowd, right? So our philosophy and our approach has been different. Now that outcome could be similar to again what others could be, and we don't compare ourselves with others necessarily. But in this case, what I'll tell you is for Meritor, not only is there a Marcellus philosophy, but again, it's a very disciplined approach, right? Investing is one area, right? And I'm sure you would hear it from different people where discipline is really, really important. Where having a good process is the key to earning long-term returns. And what again, like I said, in MeritorQ we are doing is we are following a completely a rules-based process, right? It's not dependent. Again, we have taken the process from the broad Marcellus philosophy, right? But again, we have not we're not taking discretionary calls, right? And also, if you go with the different mutual funds, you would also realize that they have their own star fund manager, right? Who you don't know, what styles they have, right? What bias they are bringing into their selection process. We are not hobbled by that. Here, it's a completely rules, the rules which are the king, rules which are driving your portfolio, and we are telling you how we have designed the rules and the philosophy or the why we have put these rules the way they are today, right? So and again, if the outcome is the same, that's for the investors to decide. And we have seen our outcomes. But yeah, that's what it is.
Yeah, right. Maybe we can have this question answered in detailed manner. So probably we'll fix up the meeting and explain this. Obviously, you see, there's no comparison between mutual fund and PMS. Obviously, it's not about mutual fund versus PMS. It's about mutual fund and PMS. You have to really understand the investment philosophy, and if it gets along with your thought process, then you should have an exposure to this. Obviously, it has some sort of advantage and disadvantages both. We can talk about that in detail, and these are advantages and disadvantages of the vehicle that in which you sit on. And nothing to do with investment philosophy. Anyway, so next question is that is there a minimum watermark return percentage? So Mr. Vidwan's no, there is no minimum guarantee or watermark return, etc. As per the SEBI guidelines. No portfolio manager can ever give you any kind of assurance like this. It is against the regulation. Next question is, I think this is the last question that we'll take. Selection by rule-based approach and not having in-depth company and channel research will take away the advantage of Marcellus' strong process. What is your views on that?
So, well, look, I mean, at some level, yes, that that concern is valid, right? Because what like we said, right, we on the call it, even the fundamental team, even in other strategies, we are following the same process. So we start with the universe, right? Almost the same BSE 500 universe. We screen out companies basis forensics, but what our team there does is they do a detailed research on the individual stocks, right? Where they're looking at, like Omkar mentioned, on the capital allocation ability of the company, whether they're reinvesting their profitability into the business, right? Or how much competitive advantage do they have? In this case, because we are not able to do that, because we are looking at, almost historic data for all the stocks, what we are doing in a way is to reduce that risk, right? Of, what in a way in other strategies we reduce that risk by doing much more in-depth research. So we can build up a position size of say more than 20-25% in individual stocks if we believe it has a great prospect, right? And we can build a much more concentrated portfolio there. In this case, in MeritorQ, what we are saying is we don't have to have that much of, because we can't get that much conviction on individual stocks. Instead, we spread out our position sizing in a way that it's a much larger portfolio, and the allocation to single stock is not more than say 7 to 8% typically. And like we said, the maximum allocation to a single stock is not more than 12%. So that in a way ensures that even though we are not doing detailed research to get conviction on the company or build a very high conviction portfolio. In this case, we are going with the rules, but in a way we are also spreading out the allocation to reduce the risk, so that no single stock drives the portfolio or contributes to the portfolio risk, right? And the other thing is again the rebalancing part, right, where we are churning this portfolio once in 6 months. What you would see is again in other portfolios our churn is much lower, right? So those would almost be like buy and hold portfolios, where ideally those 15-20 companies we want to hold them forever, right? Ideally. But in this case, because we are rebalancing often, some of this risk is also reduced, right? In other way to say is, even though we don't have good understanding of say the business prospects or the future growth expectation of the company, in a way because we are rebalancing more often, the sequence of steps ensures that portfolio gets refreshed per the rules every 6 months, right? And again, the allocation part as well as the rebalancing takes care of the fact that we are not forecasting the future, or we are not trying to get some view on the future prospects of the individual company.
Sorry, Vikas, we can.
You hear me now?
Yeah.
Yes.
Okay. All right. So with that, we'd like to conclude the session here. Thank you so much, gentlemen, for taking the time out talking to all our investors. A big thank you to all our investors who have joined us today and raised their questions.